Welcome to Drill Down Earnings. We have quarterly results out from Cisco. I'm Cory Johnson, Chief Market Strategist with Epistrophy Capital Research. We look at 50 most important companies in technology, and if you don't think Cisco is one of those companies, you know what you're talking about. And I heard such commentary this morning on some business broadcast news with some people who are sort of remembering Cisco from the dot-com era and thinking they hadn't caught up for the AI era. These results and this guidance shows otherwise, but they were mixed, I think. Wall Street loved them. I thought they were good. Let's take a look. Q1 2026 earnings for the company, fiscal year 2026, better than Wall Street estimates. Who cares? They always beat estimates. Wall Street wanted 98 cents. It got $1 per share. Wall Street wanted 14.8 billion. It got 14.9 billion. Again, not a big difference here, but the miss and the beat doesn't tell us a lot here. These guys saw a lot of growth. Growth is back, 8% growth for this company that was struggling 2 years ago. They did a huge acquisition in Splunk, and with their acquisition in Splunk, they helped buy some new businesses, buy some growth because they took the Splunk products and put it into the massive Cisco sales team. But the real story here is networking still, and it's still infrastructure growth in AI. 1.3 billion in AI infrastructure orders from their hyperscalers in this quarter. Balance between their Cisco Silicon One systems and their optics. You know, we talk endlessly on this podcast about what's going on in optics and connecting AI data centers together, and we see that here. Really strong, you know, again, 3 billion. So again, they did 1.3 billion in AI infrastructure orders in the quarter. They say they're going to have 3 billion in AI revenue for fiscal year 2026, of which this is only a quarter. So 23% operating margins. They like to talk about how they beat estimates for non-GAAP operating margins. Much as I love the folks at Cisco, I'm not going to give them credit for that because I'm just going to go with the GAAP number. The non-GAAP number of 34.4, that's what they want to talk about. 22.6, which is what we'll call 23% operating margins. Improving, again, for a company that was struggling a year and a half ago. Now, you think Cisco, you think networking, and you should. 70% of revenues this quarter from networking, as well as security, very big security. The Splunk business mostly fell into some security, not into collaboration, and then the rest of it fell into observability. So let's go backwards here. The small observability business that was 2% of revenues, growth has ticked up there. Now, year-over-year growth, when you look back the last few years, you got to kind of ignore those numbers, those huge growth numbers, because it was the addition of the Splunk revenues that made it look, the growth rate look so big. But 6% growth, better than we saw last quarter, driven by their 1,000 eyes product and again, more AI-linked use cases. Their collaboration business down 3%. Again, not a huge business for them, at 10% of revenues, that's not a great sign. But the networking business, up 15% on a year-over-year basis, their biggest business growing at the fastest pace of any other businesses, to $7.8 billion. It's the fifth consecutive quarter double-digit growth. They talked about this campus refresh cycle. So they go into corporations, they go into college campuses, they go into small cities, big and small, and they wire them. And they're saying that this is just a need for refresh, enterprise demand, particularly for businesses, right? So switching, routing, wireless, multi-year, multi-billion-dollar refreshes going on in this industry. Cat9 wiring, Wi-Fi 7 adoptions, ramping faster. And they say it's happening faster than prior launches. So companies are spending to upgrade their networks. Specifically, they talked about their P200-based 8K router, which is incredible speeds of 51.2 terabytes per second for AI use. AI within an office campus, moving all that data, moving all those queries, moving all that work around. Cisco's right there for that. And they say they're going to see a lot of that. But I also want to note that their security business, which is mostly Splunk, was down 2% on a year-over-year basis. And we've seen those growth rates sharing. I don't think it's such a huge concern, and here's why. They're shifting from an on-prem sale of one big chunk of software to cloud subscriptions. And when we've seen companies do that, Adobe famously did that. For a long time, the growth rates were hurting, but the overall business was growing. It just didn't look like it in the numbers because they're going from selling big chunks of software to selling subscriptions. They're doing that at Splunk right now. They're taking the pain there, but it doesn't make the numbers look very good. So I also want to mention that their buyback. Their buyback is making the numbers look a little bit better. This company does, for years, issues stock to buy companies, then buys back shares to lower the share count. So it raised earnings per share by about 3%, which of course is just a little bit better than what the earnings per share beat was. How did the market react? The market loved these numbers. The stock shot up 8% right after and continued to rise during the earnings conference call. And indeed, the stock already came into this up 26% for the year. That's about double what the S&P 500 has done for the year. Another point of concern, at least for me, is inventory growing. Inventory is up to 60 days. Now, they're getting ready for a lot of sales. They say they've got a lot of orders, but I always keep an eye on inventory because inventory has been a problem for Cisco in the past. And their RPOs were actually down quarter over quarter, 1%. So their remaining performance obligations, orders, however you want to characterize that, it's not an auditable number, but you like to see that number go up, but didn't go up. Nonetheless, Chuck Robbins, the CEO, is so excited about the opportunity from AI and talking about these big numbers growing and how much they're going to grow kind of right now. And also talking about what memories there are from the .com bubble and what it means to have these circularity and these deals with customers and vendor financing and companies trading business and taking across current ownership stakes. Well, here's what Chuck Robbins, CEO of Cisco, had to say about that.
I think this is a common question that we get, particularly since we lived through it. I think there's a few differences. I think that the speed at which this transition is moving is even faster than what it was, I think, at the turn of the century and in the .com days. I also think that the companies that are investing in this are massive, strong balance sheet, strong cash flow, profitable companies. And that's a lot of the spend is coming from companies that are incredibly strong, who view this as existential, right? And so there aren't as many companies that are making bets that don't have business models. I mean, there's clearly going to be winners and losers, but I think there's such a concentration of spend from highly profitable, strong balance sheet, strong cash flow companies. I think that's a big difference. And I think the pace at which this is moving is meaningfully different. I think just to be determined, sort of the impact on society and the impact on business relative to what we saw at the turn of the century around 2000. But it is the pace is what's hugely different for me. So it's an area we're really excited about.
So he's really excited. He's always excited. He's a good CEO. He's supposed to be always excited. But I think we do see, I agree with what he says about this, the better balance sheets, the better business models than we saw in the .com era when a lot of the growth was accounting and stock option fueled. But we'll see. But what's it all mean? What's your big drill on earnings takeaway? What's the one number that tells us a whole lot? Well, I've got that. But first, please subscribe to this channel. Let us know that you're watching and listening. It helps us prepare these episodes and give you a lot more of this to come in the future. But you're drilled on earnings somewhere. You want a number that tells you a whole lot. I've got all that. So Cisco Q1 2026 earnings, your essential summary, your drilled on earnings takeaway tells you that they beat Wall Street estimates, whatever, $14.9 billion in revenues, $1 in earnings per share. But their big networking business grew, but their Splunk business is going through a change. And the drilled on earnings bite, the one number that tells you a whole lot, is that they did $1.98 billion in security revenue, a lot of that in Splunk, but they're changing Splunk from on-premise software to subscription software. So those numbers might be a little bumpy for the next few quarters, but overall, really strong quarter for Cisco. All right, thanks for checking out Drilled on Earnings. I'm Cory Johnson.